Okay, welcome and thank you for taking time out to join us for this quarter's version of WP90X. Again, 90 minutes of extraordinary education. We're going to do our best. At least I'm going to lean on these guys to do their best to give you the extraordinary part of it. But it's on untapped gold mine using existing life insurance for private placement life for PPLI or private placement life insurance. So before we get started, I'd like to go through just a few housekeeping items. And so first, it's going to run approximately 90 minutes. If I know Ben and Anthony, they're going to probably end a little bit on the early side and give you guys a little bit of your morning back. But this is going to be worth 1 credit hour. So be sure to answer all the NASBA required polling questions during the presentation to make sure that you're eligible for credit and you're not going to be graded. There's no right or wrong answers, just submit a response if you wish to get CE credit. As far as Q&A, important, please type your Q&A or your questions in the Q&A feature that's at the bottom of your Zoom toolbar. Don't use the chat function. And then for any additional questions, including technical items regarding the presentation today, please message the WealthPoint team in the chat or reach out to Kristen at wealthpoint.net. Lastly, there's going to be a survey if you're interested in receiving CE or CPE credit for attending the webinar. We need you to complete that survey, and then your certificate will be emailed out to you within 30 days of the completion of this webinar. But without further ado, first like to introduce my partner and very, very good friend as well, one of my favorite people on the planet, Ben Rainey, who heads up our private placement services practice for WealthPoint, and then also Anthony Stanek with IPL or Investors Preferred Life. And rather than me butcher his bio, and I'm sure he's not going to beat his chest and tell you his whole life story, but Anthony, would you do us a favor and just tell us a little bit about yourself, your background, and your company?
Yeah, absolutely, Ryan. I appreciate it. And thanks, Ben and Ryan, for having me on today. Really look forward to going over this PMC general overview. As Ryan had said, my name is Anthony Stanek from Investors Preferred, head up distribution for IPL, basically working on all things from a distribution standpoint and IPL out in the universe. Now, kind of one thing that sets IPL apart is we're a private placement carrier only, so just PPLI and PPVA. And on the PPLI side, one of the interesting kind of product mixes that we have is the private mortality coverage that we're looking to review today. And it's one of those things when it works well, it works really well. It's just there's a couple stipulations of what you're looking for in the universe and some checkpoints, if you will, throughout the process that you want to make sure that you have in place to see if it's going to be something that's very successful. So again, appreciate the time today and look forward to going over it with Ben and seeing how you guys can kind of bring this into your practice.
And Ben, maybe a few words about you and your role within our practice for those that don't know you.
Yeah, thanks,
I don't
Ryan.
know who those people are. They must be living under a rock,
I was
but
going to say, if
yeah.
you've not gotten a bunch of PPLI related emails from me by now, too bad. It's the gig's up, and you're going to start getting them. No, thanks, Ryan. I'm glad to be here. This is actually a redo, so to speak, or an encore presentation. Anthony and I did this presentation a couple of years ago, actually. This is a new one. We've revamped it, redone it, partly just to make it easier to digest and understand, but two, because we think this is such a critical component of our practice going forward. We've been neck deep in the PPLI space now for a number of years. I lead that for our firm, but we really think that this is one of the most overlooked aspects of PPLI. I like to call it the easy button for those that think PPLI can get really complex and in the weeds about things. This isn't necessarily easy, but it's probably the fastest, easiest way to get PPLI in place for your existing clients. Yeah, so with that, let's roll right into where we're going to be headed today. For those of you on the call with ADD, good news. We're going to do kind of a two-part presentation. There's a bunch of learning objectives here. We already sent those out as well for the CE credit. But really, if you want to think about where we're headed from a roadmap perspective, we're gonna hit the simplified overview of the concept and give you guys some big ideas to kind of lock in on. And then we're gonna do a detailed case study where we actually break it down how it actually works step by step, line by line. And then we're going to unpack the 3 different carriers in the space that do this. Of course, leading with Anthony's IPL's product and how they do it. But we want to kind of do that in a way that, again, lets you guys see it at a high level, really dig into what it actually, or how it actually works, and then really understand the steps. So, Anthony, anything to add here before we jump in?
No, that's exactly correct. Yeah, I look forward to it.
Yeah,
Just
Ryan.
one thing to add, again, for those of you that joined after I did the housekeeping items and announcements, please use the Q&A function, not the chat feature, to ask any questions that you'd like answered, and I'll relay those to the 2 speakers. Thank you.
Yeah.
Awesome.
So we'll jump right in, and we're gonna have 4 big ideas for you guys right out of the gate. The first one is this: you can utilize any existing life insurance policy for PPLI, and by that I mean type, right? So on the right-hand side here, we're going to be talking about term insurance works, whole life, universal life, all the variations, right? The index, the IUL, the VUL, the variable universal lives, survivorship policies for those insuring 2 lives. There's really not a type of life insurance you can't use for what we call repurposed or synthetic. Anthony's got his program is called PMC, but any type of life insurance policy can be used. Now, I do want to give you one quick caveat. Anthony, maybe you want to touch on real quickly, while any type can be used, talk for a minute just about carrier financials and how that might play a role in, and maybe we won't use a certain policy because of a carrier, underlying carrier financials.
Yeah, exactly, Ben. It's a great point. As Ben had mentioned, policy types, everything that's listed there is something that could theoretically be used in the structure. In IPL's PMC structure, one of the things we're going to take a look at specifically on the permanent side is the overall health of that underlying policy, right? So from time to time, we'll take a look at something and maybe that policy has not been, funded correctly. Maybe that policy is running out prematurely prior to life expectancy. So maybe you want to have something that, is only running out to the client's age 60 or 70, not going to be something that we're going to want to utilize in this structure. In R1 in particular, one of the very first steps is we want to see an in-force illustration on anything that's permanent, right? So if it's not something that's being put in force new, it's something that's already existing in force. We want to see that policy is running out to at least age 95 under current scenarios. Same thing when it comes to term. We want to make sure that we're always kind of meeting 7702 guideline testing, modified endowment contract testing, obviously very, very prevalent in that first 7 years, so that 7-pay test. So as Ben, is well aware, and anytime we kind of do one of these PMCs, or what stands for private mortality coverage, basically you're bringing the coverage to the PPLI transaction, we're going to get a general idea of the health of that existing policy, or if it's something that's new that's putting in place. And one of the things that Ben had also mentioned there was health of the overall structure, right? What type of carrier is underwriting that risk? We're going through that now with Phoenix Life, right? That's one that's kind of in receivership right now in our structure. Fortunately, we don't have anything from Phoenix Life in the PMC structure, but that's something to keep an eye out for, right? Health of the overall carrier that's also in this synthetic structure. So these are all different things that kind of, when we're first taking a look at one of these cases, we want to make sure that we kind of dot the I's and cross the T's from a very first step.
Yeah, but I think that, yeah, Ryan.
Just a quick question from the audience. It's actually a 2-part question. The first is, do you believe that a trust that owns PPLI must be a non-grantor trust, or is a grantor trust okay? And I know the answer to this, but I'll defer to you guys.
Well, I mean, you can answer it if you want. You're right there. No. Trust structure is it can be either. Yeah.
Yeah.
Did you say it was a 2-parter, Ryan?
Yeah, and then does the client need to be currently insurable or use a group term policy is the next question from one of our folks. And I would say just stay tuned. This is predominantly for folks that are not insurable, that have existing coverage in force. And so I think that's going to be covered here pretty quickly.
In fact, On that note, no, there's no new medical underwriting needed.
Nice transition.
Yeah, and again, for all these things, guys, I want you to know these are the big ideas. There's nuance, like Anthony just unpacked with using any type of life insurance. There's some carrier consideration. Same thing here. There's some nuance to all this, but we just want to try to crystallize for everybody on the call just the big ideas. So you're not trying to worry about all that in the background. Just bring us the idea, bring us the case, the client situation, and we'll help you unpack it and get to the bottom of it. But this is actually a big idea here because it opens up PPLI for a couple of things. That's that second part on the right-hand side, though. One is speed of implementation. I mean, regular full medical underwriting can take 2 to 6 months or more in some cases, right? I mean, you're tracking down very busy, very wealthy people. They've got extensive medical records all over the place. We know this because this is what we do day in and day out, right? But being able to take an existing policy, not have to go back through underwriting, you don't have to do any doctor's visits records, you have to do any new exam, none of that. You just grab a policy, use that as the underlying death benefit, and so we don't have to recheck medical. So it speeds everything up. And again, if someone's uninsurable, no problem. And again, as we get older, again, because this is already considered a sunk cost of the existing policy, that opens up PPLI to those people that are over 70 years old. Anthony, anything to add here?
Yeah, I mean, and that's a nice part of this. Usually when we're talking about kind of traditional PPLI, it's sometimes G1, right, using G2 lives or even G3 lives, depending on age. And the nice part about this is sometimes it's working with G1 who's already done some level of estate planning, right? They already have some permanent insurance in force. Maybe PPLI is brand new to them, right? And, one of those big kind of barriers sometimes to any type of insurance is a cost of insurance component that is new to the client. Here's one that's already been in force, right, for a period of time. So that cost of insurance kind of speed bump sometimes in the conversation is kind of a moot point in some of these synthetic transactions.
That's right.
What if I have a client that has a policy, let's say they bought a 30 or $40 million no lapse guarantee policy. It was structured as a 10 pay, and there's no more premiums that are required. Does that fact pattern work in this PMC type situation?
Yeah, absolutely. I mean, that's when kind of IRR looks the best, right, if you will, because any COIs that are ongoing in the retail policy will actually be, COIs that are paid inside of the PPLI structure. So in that particular case, maybe the client has a 10 pay. We're now in year 15. That policy is technically paid up from a guaranteed standpoint. We can still use it as a PMC product and use that and repurpose that insurance. And there are no further cost of insurance premiums moving forward. So obviously, internal rate of return looks wonderful on your additional PPLI separate account assets.
I argue that's the ideal policy to put it in one of these structures. It's already paid for. It's just sitting there, typically in a trust. You just now get to use it and make it a dual purpose asset.
Ben, another question from the audience. Do you guys act as a manager of the new PPLI? How are the investments selected? So I think there's really two parts there that we'll get to.
Yeah, we'll get to that. We don't act as the investment manager. As most of you guys on this call know, we're strictly in our insurance lane. We only do the structuring, the implementation, but we leave the investment management up to our partners in the space that do that. And we'll unpack that more here in a minute as well. So the last two big ideas are actually connected, which is why they're on the same page. First is there's no loss of existing life insurance death benefits. So again, when people first hear about this, they think, oh, I'm going to use my policy and assign it to a PPLI carrier or whatever. I'm going to lose the death benefit. It's absolutely not the case. Whatever death benefit you currently have, or your trust or your client or whatever has, they maintain that life insurance death benefit. And that's really important, right? I mean, if these clients have life insurance, and everyone on this call probably has a client in mind, right? They know they've got a client with existing life insurance. They bought it for a reason, and they need to maintain it for a reason. We're not going to disrupt that, which leads into big idea number 4, which is there's no change to existing estate planning because everything's maintained from a death benefit perspective, from the ownership perspective, the beneficiary perspective on the right-hand side. Everything stays the same. The only thing we're doing with synthetic or repurposed PPLI is we are creating a new PPLI account that grows tax-deferred, can be accessed by the owner tax-free, and then is paid out as a tax-free death benefit to the beneficiary. And we'll show you guys all the math on this. But again, I think this is really, really important You're not losing any benefits, and there's no change to the existing planning. What does repurposed PPLI, what's the framework actually look like? And again, we've been explaining this for years. Anthony, I'm sure you've got a way, kind of the elevator pitch, so to speak, to quickly explain to folks what it looks like. But I'll ask you for how you explain it to people. But really what we're doing is we're taking an existing life insurance death benefit, we're assigning it to a PPLI carrier, Anthony, in this case at IPL. And what they're doing is they're basically doing a U-turn with that death benefit and reissuing us a brand new policy for the exact same amount of death benefit, plus this new tax-deferred investment account or this PPLI account. It's a really simple, elegant way of providing your own death benefit that supports this newly issued policy. I've said it before. I've said it many times, Anthony. I think we said that when we first did this a couple years ago. If I asked you to insure me for $5 million and not you as the carrier, but you as an individual, you'd say, no, I don't want to insure you, Ben, for $5 million. But if I assigned my existing $5 million insurance benefit to you and said, you're now the beneficiary of this policy, you could easily, issue me a policy, right, for $5 million or whatever the number is, because you've now got the backing to be able to do so. So Anthony, how do you explain PMC or repurposed PPLI, cleanly and simply to folks when you're trying to first get the picture across?
Yeah, I kind of say it's almost a Y in the road, right? And two different reasons of why you would use PMC or synthetic life. The first one is one that we haven't touched on yet, but I know we will at some point. Usually clients that are looking at PPLI are high net worth, ultra high net worth clients, right? That might already have hundreds of millions of dollars of insurance already in force. Well, just like any insurance carrier, and IPL is no different than any carrier in the retail space or in the PPLI space, there's a certain amount of reinsurance capacity that's available in the world for an individual client, right? Client might want to put in 50 to 70 to $100 million into the structure, but that might require a $300 or $400 million death benefit that is not available in the universe doing traditional life insurance underwriting. So one of the reasons that you'd use a PMC structure is you'd go out to other retail carriers and kind of stack that retention on top of one another to get to the death benefit that's necessary. And that's 100% legitimate way and a reason why PMC would be used. Kind of the second path down that Y in the road is a client that's already done some planning already, right? Some estate planning. They've used some of their gifting exemption. There's money in ILIT. There's money in slats. There's money kind of out there and about. And the life insurance policy kind of sits as an asset that's obviously going to provide liquidity upon death. But maybe there's an income tax issue, right? They're trying to invest in other alternative asset classes that are not as kind from an income tax perspective. Well, that's kind of, if you think about it, a benefit that's being left to the next generation, but hurting that client in their taxable year as it stands right now. What if we're able to repurpose that current death benefit that we have and utilize it in a tax efficient structure? And that's where kind of PPLI comes into place and is super effective. So I think we're kind of doing two things at a time. We're not only taking care of estate tax issue and legacy planning, but we're also addressing income tax planning as well. And here's just one way of kind of combating that using this structure.
Yeah. Great examples there. Ryan, you have something?
Yeah, a question. If I have life insurance in a standard life insurance trust, and maybe it's in a dynastic trust, but I've done sales to defective trusts that have popped value realizing event. There's a tremendous amount of liquid assets, but in a separate trust structure, how do I then get those investments into the trust that owns the life insurance or vice versa in order to use it? What's the ideal fact pattern? Also, as a follow-up question.
Well, I would say the ideal fact pattern is where the insurance and the assets, the investable assets, are in the same bucket or the same trust structure. Obviously, that just makes things a lot smoother and easier. And the example that we're going to unpack here in a minute, actually, that was the case study, the example. But Anthony, maybe you want to touch on, when they're in two different structures, how we navigate that, because that's certainly something that comes up a lot.
Yeah, absolutely. Yeah. So, when we're thinking about, repurposing insurance, the kind of trust ownership structure has to stay the same. What I mean by that is, let's say, for example, we have money in an ILET, we have a $20 million current policy that's in force. That same beneficial owner and beneficiary has to remain the same on the new PPLI structure, right? So that ILET needs to be the owner of this newly created PPLI contract. It would be nice if we were able to kind of split ownership and kind of get the best of both worlds and have money, death benefit pay outside of the estate, but have access to the cash inside of the estate. But we have to do some of that trust planning or any change of ownership on the trust. It has to match where that current death benefit is currently residing.
Okay.
Yeah, so there's more to that. And if there's a specific situation that's coming to mind, whoever asked that question, we can certainly unpack that and talk that through. There's certainly solutions to getting a structure like this to work and getting that to work for that client. All right, so we talked real quick about we're creating a brand new repurposed PPLI policy by assigning the death benefit to the carrier. They issue us this new insurance policy with this PPLI account is what we call it, right? So let's talk about the PPLI account framework and how to think about how much money we can contribute to this new PPLI policy. And so everybody on the call, again, you've probably got one of your clients or a couple of your clients in mind that have existing insurance, and it's going to be super easy for you guys to think about, all right, how much could we contribute? And it's really in that first bullet point there. It's the insured's age is roughly the percent of the death benefit that we can contribute in premiums into this new PPLI policy. All right. So, and then survivorship policies have a slightly reduced premium percentage. So if you've got a $10 million policy and the client's 60, you're going to get about 60% of that death benefit or $6 million of premium into this new repurposed PPLI policy. If it's 30, 60% of that's about 18 million. You guys can do the math, right? So again, that's just a rule of thumb. It's going to change based on the underwriting classification, a bunch of different factors. But that just gives you an idea of, again, how much money we can now dump into the PPLI policy and protect from ongoing taxation. And this example you see here on your screen, this is the one we're going to do kind of line by line or step by step. It's a $30 million existing policy. The insureds are age 63 and 61. Under Anthony's PMC structure, we actually ran this through their structure. We could get 47% of the death benefit in new premium contributions. So we assign the $30 million policy to IPL. They issue us a new $30 million PPLI policy, and that can now accept 14.1 million of new premium contributions. And if you see in the chart below, what does it actually look like from a death benefit perspective? So once we get the new policy, we get the death benefit, right? That's always there. We always talk about that. That's never going away, that $30 million death benefit. But you're also going to get the PPLI account plus any gross in that PPLI account paid out as the death benefit. So on your screen here, when you see this existing death benefit, there's that $30 million policy. There's an extra $10,000 here. We'll get to that here in a minute. But the total death benefit now encapsulates both the $30 million death benefit plus that 14.1 million that's growing tax deferred and ultimately pays out a tax-free death benefit. Anthony, anything else to add here?
No, that's exactly right. Yeah. So, I mean, anytime we're thinking about this, I always think of the synthetic side as kind of liquid death benefit, if you will, right? That's available immediately. Separate account assets, obviously, depending upon what they're invested in,
Right.
going to be a level of liquidity to them. But with that said, receive a step up to whatever it is upon death of that separate account assets. So
Right.
I always kind of think of those as conceptually two different things, but the net to heirs, tax-free being the biggest, thing to make sure that we're highlighting here.
Yeah, Ryan, just one second. I just want to tag on that and then I'll come to this question. I do think a lot of people think PPLI is just about those highly tax inefficient assets. Don't forget, just recapturing the step up in basis through the payment of the tax-free death benefit in a trust can be a really, really, cool thing as well, right? I mean, you're not picking up 45, 50% of alpha, so to speak, in the tax policy or inefficient tax assets. But boy, even some boring positions actually work really well in trust structures. Ryan.
So, first question is, what carriers do you use? But I just wanted to kind of bifurcate that. So, we're part of M Financial Group, so we have access to the MagnaStar product, which we've got Prudential, Pac Life, and Nationwide. We've got access to other PPLI carriers, but this in particular is focused on existing life insurance, which could be a wide array of carriers, but maybe. In this case, I assume it's something like a John Hancock, Pac Life, Prudential, whatever it is, but you're using that existing policy. But Anthony, you just spoke to carriers that may be off limits, like the Phoenix Life type carriers, carriers that are in severe financial stress. But are there very many carriers that we cannot use for PMC coverage?
Yeah, no, I think there's not too many from a kind of ban list, if you will, that are having issues other than, that in particular. I think the biggest thing is more of health of the underlying policy itself, right? Whether that's from a John Hancock or Pacific Life or Prudential, whoever that underlying synthetic insurance is from. Many times, when we take a look at that in-force illustration right up front, we get a general idea of, hey, this is a healthy policy or this is something that could be used inside of the structure. Because we're kind of taking on that administration of that policy going forward, making sure those premiums are paid, making sure that policy is running out as it was originally intended to do.
So it's almost like the policy is being used as quasi reinsurance for the
That's
IPL
exactly right.
policy that's been issued. Another question that came up, is there a funding structure that's most optimal? You guys are showing a MEC in this example, but
Mhm.
is it always a MEC? Is it a non-MEC? And again, I know the answer to these, but I'm not the one speaking. So,
Yeah. Well, I would say, interestingly enough, the funding idea is very similar to any PPLI transaction, right? Whether that's, traditional PPLI or this synthetic PPLI structure. Usually, many of the times where we'll receive a request, albeit from Ben or anyone else, the client has a general idea of how much money they're looking to put into the structure, albeit 10, 15, $20 million. We'd love to take it up front in year one, right? But that's going to kind of run into some of those issues that Ben had just highlighted of percentage of the death benefit that we actually need, right? So let's say in this particular example where we have a $30 million death benefit, if we wanted to make that a non-MEC, we might need to do a 3 or 4 pay duration of kind of putting that $14 million in over a period of time to make sure that we don't MEC that contract. Now, the nice part about structuring these is South Dakota is very good from a premium tax standpoint. We also have Alaska. Some of these states allow for backdating of 6 to 11 months that allow us to really get those two premium payments in within 1 calendar year, right? So many a times we're really identifying the total amount of premium deposit coming to somebody like Ben. He works with our design team very closely to say, I know you want to get it up front in year one, but take a look at this 3 pay, and it all comes down to IRR, right? What is going to look the best and most efficient way of getting that premium in a quick nature where it can get deployed into the separate account, but we want to make sure that we do it in the most efficient way possible.
guys, there's follow-up questions about investment manager, and Ben, you touched on this and you said we let them do their job. But can you please clarify for the audience what that typically looks like in terms of the client using, in a lot of cases, their existing investment manager through a separately managed account structure or an existing IDF, insurance dedicated fund that they want to get to, because it seems like there's some confusion there.
Yeah, again, we'll unpack it again more, but let's just go ahead and get there real quick. So the current, PPLI investment structure really is it's an either or a both and kind of structure. One is you can do IDFs, insurance dedicated funds, which are prepackaged investments approved by each insurance company. And so those are some very well-known marquee names. There's also some very much smaller type investment shops out there, but some of the more well-named knowns would be like Millennium and Golub and Blue Owl and Apollo and various other Bain Capitals and other ones, some very well-known names. There's some smaller fund managers on there that people like. There's also ETFs or VITs, which are exchange traded funds, so you can get broad equity exposure that way if you'd like. But the real kind of money movement in recent years has been again, I said both and, people still use those IDFs and those VITs, but there's also been the very rapid adoption of SMAs, or separately managed accounts, where the existing asset manager is approved to manage money on a completely custom basis. So they basically, the money drops into the PPLI policy, then gets dropped into a Schwab or Fidelity account. The existing asset manager is then approved as the asset manager on that particular account. It gets householded with the rest of there from a reporting perspective, things like that. But then you can trade it just like you would a taxable account. You can trade that account inside the PPLI policy as well. So you can do anything from individual stock positions to, again, prepackaged funds that you or your firm might offer. It's really a wide gamut of things that you can do on that side. There's a lot more to unpack on that, on how that all works. But from an investment management perspective, it's really one of those two things, or again, a combination of those things as well.
And another question, if it has an increasing death benefit, like obviously this does, or just about any PPLI contract, do you continue to participate in the death benefit increase? And again, it's just as illustrated on the screen, you get the growth of the cash value plus the original death benefit. So the answer is absolutely and unequivocally yes.
Yeah, and if the death benefit somehow grew, right, if there was underlying cash value that pushed that up as well, you would get that benefit as well.
Okay.
So let's talk for a quick minute about costs. So what's this structure actually cost? And maybe even compared to what a traditional PPLI policy would cost. And Anthony already mentioned it, right? The existing life insurance policy costs are already accounted for, meaning, when we meet with a client, like the $30 million policy we just looked at, and we're going to unpack here in a minute, like that's already been bought, right? I mean, the trust is paying for it. They have a plan for paying for it. So we basically disregard the COIs, or the cost of the insurance, because it's not a new cost, right? It's already a sunk cost accounted for. The only new cost of the PPLI policy is going to be some initial premium fees, so federal and state premium taxes, and then our structuring fee, which is typically around 50 basis points. And then on an ongoing basis, it's only the mortality and expense fee, the M&E fee, which again is going to average around 40 to 45 basis points over the lifetime of the client. There's breakpoints in there. We can unpack that later. But really what you're going to get with a repurposed PPLI policy is an all-in cost of somewhere between 40 and 50 bips amortized over the client's lifetime. So it's a very efficient, very effective way of acquiring PPLI, again, with very nominal cost. And again, when you compare that to the annual tax drag that most of your clients are paying, it's a complete home run. Anything, Anthony? I know we can. There's the de minimis insurance cost when we add $10,000 or $50,000 in there, but for the most part, these are the big costs that we see on structure.
Yeah, and I think the nicest part about it is, from a illustration standpoint, here's where it always kind of ends, right? I know Ben's done a ton of those presentations where he asks for what is the overall tax drag on a client's current taxable portfolio. Compare that to the structure, and that's kind of where you don't only see the client get it, but any estate planning attorney or anybody else that's in the room, it's kind of the light bulb moment, if you will. I'm trading 40 or 50 basis points of cost for tax-free return. Why would I not do this? Is usually right. the general conclusion to those conversations.
Yeah, we always hate to say things are no-brainers because people like to run for the doors, but again, this becomes a very obvious. I should probably do this. All right. So let's do a quick recap before we jump into the step-by-step how this actually works. So big ideas again. You can repurpose nearly any life insurance policy for PPLI. There's no new underwriting. There's no loss of death benefits in any way, and there's no change to existing estate planning. Now, from a structural concept perspective, remember, we're creating a brand new policy equal in death benefit to an existing policy, and we're simply adding a new PPLI investment account. All right. The amount that we can contribute to that account is then, in terms of premium contributions, is going to be roughly the age of the insured as a percent of the death benefit. And by the way, you don't have to do the max, right? If you have a $10 million policy and you got a 60-year-old client and they only got $5 million liquid, no problem. You don't have to do the maximum. That's just the most you can do, right? Most PPLI is funded to the max, but you don't have to do the max premium allowable. The premiums or the investment account is managed by the existing asset manager in most cases. And if you don't have, if there's someone on the call or someone has a relationship where they want to do all IDFs or whatever, we can certainly accommodate that. But in most cases, the existing asset manager manages those dollars, and you can invest in nearly any asset class. The tax benefits of PPLI, as almost everybody on this call knows really well, but you get the tax-deferred growth, the tax-free access during a lifetime via withdrawals to basis and policy loans, and then tax-free death benefit that's paid out as well. The repurposed PPLI death benefit equals the original death benefit plus that investment account plus growth minus policy costs. And again, those estimated costs are really going to be around 50 bips or less in almost every case.
Anthony, how important is Section 1035 to the transaction? Does it place any limitations on repurposing policies? And
so
there's a follow-up question. Could I use this, do this with an offshore policy?
Yeah, so interestingly enough, 1035 doesn't play a role in a synthetic transaction. 1035 would play a role if the client is looking to take that equity that's in a current policy and bring it over into a newly underwritten PPLI contract. So that would be just a little bit of a different from a structural standpoint. Any underlying insurance that we're using, we're repurposing the death benefit, but we're not moving any of that liquidity that's inside of a policy if it maybe has cash or anything along those lines. To the second part, we can take a 1035 from an offshore carrier to investors preferred, an onshore carrier here in the US, but that would require new underwriting.
But can you use an offshore policy death benefit for the PMC coverage?
Everything here is domestic carriers that we're utilizing. Yep.
Guys, a couple of our trust and estate attorneys have asked, Anthony, can you explain the specific structure for the estate planning trust and estate attorneys in terms of the steps needed to be taken in order to implement something like this?
Yeah, absolutely. And have a great white paper as well that kind of goes over it that I'm more than happy to share afterwards. So what occurs is, let's say, we'll use Ben's example originally of client has a $30 million contract in an ILET, if you will. We would go ahead and change ownership of that existing contract in that ILET to a Delaware LLC. That Delaware LLC is then purchased by IPL's segregated account as soon as that newly issued PPLI policy is owned by that same ILET. So that is the one section that takes place in our PMC product that's a little different than some of the other carriers that offer a synthetic structure where they're just assigning the policy. Now, what that one extra steps allows us to do is we then administer that ongoing premium payments, if there are cost of insurance payments, on that existing policy moving forward. So in any illustration that you see, let's say, for example, that $30 million in-force policy had $100,000 a year of cost of insurance. In our newly issued PPLI contract, you would actually see a cost of insurance of $100,000 a year being paid, and we're paying that out of the separate account of the new PPLI contract. Now, is that one extra step than some of the other carriers that offer synthetic than just a assignment of the death benefit? It absolutely is. Now, the reason we do it and go forward is when you're assigning that death benefit, we think our structure gives you a little bit more see-through, that we're making sure that premium payment is being paid, so we never have a lapse of that underlying contract. In assignment of death benefit, let's say a trustee forgets to pay a premium or something like that occurs. If there is a lapse of that overall coverage that's enforced, well, kind of blows up the entire structure because now there's no insurance in force, right? And there could be a taxable event of gain in the contract. So we think even though there's one extra step in our structure, we think it's slightly more secure that there's see-through and IPL is taking on that administration of paying that cost of insurance moving forward.
Thank you, Anthony.
Yeah, absolutely.
Yeah, and we're going to run through that example right now. Again, you guys can see here on your screen just kind of the step-by-step how you actually would implement one of these things. So you identify the existing policy or multiple policies to be used. We'll do a model of what it would look like, comparing a before and after type scenario for you. We'll then meet with your client. We'll get buy-in from them to do it. We'll then prepare and submit the new application. The insurance carrier then issues the new policy. This step that Anthony was just talking about in terms of the LLC versus the assignment of death benefit, that's where it varies by carrier. Again, that's why we have assigned in quotation marks there. Again, depending on which structure we pick and we use, it'll either be assigned to the death benefit, will either be assigned to the PPLI carrier, or we'll sell it to the PPLI carrier. Then the PPLI account is opened. The premiums can be contributed to the account and invested. And then the future premiums, as Anthony just said, get paid from that new PPLI account. And we can do that in any of these structures that exist. And again, start to finish, 2 to 4 weeks instead of 2 to 6 months. So very streamlined, very quick implementation program compared to traditional PPLI. All right, so let's roll through the case study that we prepared for you guys to get a kind of a deeper dive and really understand how the mechanics of this really work. So this existing WealthPoint client, both in their early 60s, they've done significant estate planning, like many of your clients on this call have done. They've set everything up. The trusts are funded. There's insurance that's been purchased for estate tax liquidity. And so the current trust we're going to be looking at here has a $30 million John Hancock survivorship policy. Ongoing expected premiums of $205,909 annually. Again, that's currently being paid out of the trust cash flow or earnings on the investments. And there's about $14 million in investments inside the trust. And the expected capital markets assumption from the investment team is a return of about 8%. And the reason that's important is what we want to do next is compare the cost of tax versus the cost of repurposing this policy and dumping it into PPLI. And as everybody on this call knows, it's going to be a very obvious decision to be made, but we do want to prove it out, right? We want to run all the numbers and make sure that we've done our homework and we can actually, demonstrate unequivocally to the client and the advisor team that this makes a lot of sense. So here's that $14 million that's sitting in the trust account, invested across a number of different funds and positions. We would do this, by the way, for any PPLI implementation. If you've been around our stuff long enough, you've probably seen this slide. Again, this is totally customizable to the investment teams on this call. You say, hey, we want to assume a different long-term capital gains position versus ordinary income, the different turnover within the fund. All these things, again, are at your discretion and at your customization, because we really want to get a really accurate view of what's really happening to the current portfolio. So again, we can compare the before and after of both positions. So this particular portfolio, 8% expected rate of return going forward, and roughly a 37%, 37.5% tax drag across all those different positions annually. And again, this is a California resident. It could potentially be higher, right, if there was more of the ordinary income type positions, but this is I would say, a fairly well diversified portfolio. So what we found down here is when we look at 8% and we pay about 37% of tax, we're net returning to the portfolio is about 5%. So that means our cost of tax is right at 3%. And again, we're going to be able to roll into the next slide and say, all right, well, what's that look like then? Status quo, which is our taxable account, versus taking the $14 million and tucking it inside this new repurposed PPLI account. So what you can see here is the account balance difference in terms of what the $14 million will grow to over their life expectancy. So $14 million grows to about $48 million net after tax in the status quo environment. $14 million grows to $104 million inside PPLI, because again, we're not paying tax in that structure. In either structure, we're going to get the benefit of that $30 million death benefit, right? The trust is owning that $30 million in either way. And so what's the total net result to the heirs of the trust? Well, it's either $70 million here or $134 million here. The reason why, real quick, this isn't $78 million is because something we talked about earlier from a tax perspective. These portfolios aren't being turned over 100% of the time. And so there's this deferred capital gains on a number of those positions, right? And so what we're accounting for in that difference of that $8 million difference is that deferred capital gains tax that ultimately the heirs inherit. Obviously, the death is not a realization event, but certainly those heirs will have to realize that tax upon a disposition of those assets. And then the last point down here is, again, real quick, PPLI is really about a location change, not an allocation change. So we don't want to disrupt the current allocation. We don't want to introduce a bunch of new ideas around investments. Certainly you can do more aggressive things, more tax inefficient things once the money's in PPLI. But when we want to explain it to the client, we want them to know, hey, man, everything is exactly as it is before. We're just availing ourselves of a more tax efficient location in order to benefit from. So pretty, like I said earlier, it's a pretty obvious choice when you can say, hey, I get to keep my $30 million of death benefit and only $14 million now grows tax free. Here's how that looks side by side, year by year. On the left-hand side is our taxable account, our trust plus the life insurance. So here's that life insurance in that column right here. Here's that $14 million that's growing every year by a net 5. Here's the cost of the insurance policy. Again, all this is kind of in its own little ecosystem, right? And that's how we get to these numbers we just looked at. On the right-hand side, again, same ecosystem. Again, instead, the $14 million, though, is tucked inside this PPLI account, growing at the same rate of return, just minus that tax drag that we just looked, or minus the insurance costs that we just looked at.
Gentlemen, real quick,
Yep.
if you can go back to that slide.
This one?
Yeah. So if my cost of insurance, but two parts to the question.
Yeah.
Anthony, if I'm paying the cost of my incumbent policy inside of the new PMC coverage, am I effectively paying those premiums now with pre-tax dollars because it's inside of a tax-deferred life insurance chassis?
Yeah, exactly correct. That's you bring up a good point. We just talked about kind of some of the see-through to the policy with our administration, but one of the key points as well is it is a true policy fee, right? That's being used with pre-tax dollars rather than post-tax dollars because it's being paid through the separate account as a policy charge. So there is a slight arbitrage of that. In this particular case, close to $205,000 of premium that's now being paid inside of the structure rather than with post-tax dollars. So that is correct.
So the second part of the question is, if that's my cost of insurance, and again, I know the answer to this, but if I were looking at this as a layperson, why is my cost going up on the PPLI side under annual cost, Ben, if you can kind of put your cursor over that, for the 318, 356, are there additional fees that are being levied against the policy and charged?
Yeah, so what you're seeing here, and I should have called that out earlier when we hit the slide, but yeah, so the annual cost column here for PPLI is going to be inclusive of this 205, right? Because we have to support that existing policy, as Anthony just said. And then the only other M&E, or the only other fee that we're adding to this every year is the M&E mortality and expense fee, which is an asset-based fee charged by the carrier. And that's why, and these are every 5-year increments, which is why the numbers are going up as much as they are every line. But the reason it's more than 205 is just that M&E fee that's levied on top of the actual cost of the insurance.
Got it. Thank you.
Yeah. So then once we've done the modeling, as we said earlier, I think it becomes easy to get the next step, which is client buy-in, right? We'll meet with the client. We'll get their blessing, so to speak, to move forward. We'll then prepare and submit the PPLI policy application. It can require a new LLC. But all the other signatures that are required from this go through DocuSign. And maybe for a second, Anthony, talk about the LLC thing one more time.
Yeah.
I know folks on the call probably heard it. They're like, okay, wait a second, the Delaware LLC, like what's going on with that? So maybe talk about that for a quick second.
Yeah, absolutely. In many of these PPLI transactions, and this is true of traditional PPLI or synthetic, you will usually have an LLC or a trust created for ownership of the private placement life insurance contract. So you'll see an Alaska LLC or South Dakota or Wyoming. And the reason for that is specifically around premium tax, right? If you were to do it in a state like California, it might be a premium tax of 2.5% of the entire premium. Well, obviously, these are extremely large premiums. We don't want to pay a 2.5% tax. So you'll have an Alaska or South Dakota LLC created because it's only 8 basis points, right? Very nominal fee. So that will always be required. And, that LLC in most cases, unless the client has a South Dakota trust or an Alaska trust, will create that new LLC. Where the Delaware LLC comes into place in our synthetic structure is where we have the retail policy change of ownership. And what that allows us to do is that allows us to acquire that newly issued Delaware LLC to be part of this segregated account of the new PPLI structure. So in the way that we do it kind of on a timeline is once we acquire that Delaware LLC that has that $30 million or $50 million retail insurance, the very next step is us issuing a PPLI contract with that very same amount of death benefit immediately, right? That's taking on that new premium. So that is the one extra step of that creation of a Delaware LLC to transfer that policy over to IPL's segregated account. Now, the nice part about that purchase document is just like traditional PPLI, there are no surrender charges. So if at any period of time the client said, this makes sense, we've done this synthetic structure 5 or 10 years down the road, the client no longer wants the structure. Obviously, there are no surrender charges in the underlying PPLI contract. But in that purchase agreement of that Delaware LLC, it states if there's a surrender of the underlying PPLI contract, IPL will turn that retail policy back over to that original owner or trust, right? So that is the one kind of extra additional step in our structure that allows for it, as Ryan brought up, for us to pay policy charges, administration going forward with pre-tax dollars through the new separate account PPLI structure. So
every carrier that does this has an exit strategy that doesn't involve death, right? So if you get into this and you want to get out, there are ways to terminate the agreement and resume ownership or possession or whatever you want to call it of the pre-existing life insurance contract. Again, I don't know why you'd want to do that, but those options are available certainly at IPL, Excellus, and Crown as well. So as Anthony mentioned, the carrier then issues the new PPLI policy using the death benefit from the repurposed policy. In our example with IPL, that $30 million policy now becomes $30 million and $10,000. And the next bullet there, again, each carrier requires nominal amounts of additional risk. And maybe touch on that, Anthony, from a legal perspective, why that is and why that's necessary.
Absolutely. Yeah. So in the way that, and this is a registered product, if you will, right, with the state, when we file the product, the states are a little ambiguous. There has to be a transfer of risk, right, coming over. Now, they don't define what that amount of risk is. So to keep it in a very cost efficient standpoint, we don't add a ton on, anywhere from $10,000 to $50,000 of risk that we take on that is a guaranteed issue, does not require underwriting for the client, and is a very small cost of insurance, a couple $100 a year, right? That is added on. But in any state regulations, there has to be a transfer of some type of risk. That's why you'll see IPL and the other carriers in this space take on a certain amount of retained risk on each and every life, each and every single new contract. We just try to keep it as minimal as possible to keep overall costs down.
That's right. Yeah. So nominal costs introduced by adding that new risk. And then the next step, again, this varies, with Anthony's program, they buy the LLC, then they issue the policy. With the Excellus program, which is the other major, provider of this, they actually issue the policy first. So the new PPLI policy is actually issued before the death benefit is assigned to them. So there's never a lapse in coverage. With Anthony's, the ones we've done, Anthony, are basically, within hours of each other. So there's really no lapse of coverage there, more than a theoretical lapse anyway. But these are important, right? So that your client is never exposed from not having the death benefit that they want and need from the program. And then the last step is the PPLI account is open and funded. So once the policy is issued, the carrier will then open the account. Again, depending on what types of investments that we're doing. We're seeing down here at the bottom, again, you can do pretty much anything you're doing taxably inside PPLI, right? So again, whether that be an SMA account where we're going to open a Schwab or Fidelity account and assign the existing asset manager to run those assets, or whether we're doing some IDFs or, again, a combination of the two. This is kind of where the magic happens, right? We've maintained the existing death benefit. We've now opened the account, the 14 million or whatever the number is goes into the policy. And then you've got your pick of assets by which to manage the money on the platform.
Guys, you've used the a question came up. What do you mean by the term synthetic PPLI policy? You guys have used that a lot, and you're using terms like IDF, SMA, which is industry jargon, but for the layperson that doesn't live and swim and breathe in this water every day like you guys, like you fish do, maybe you can open up the box a little bit for
Yeah,
those folks.
absolutely. Well, we use these terms to make it sound very complicated.
And we got to sound smart, Ryan. Come on.
Yeah.
Exactly. So each and every carrier, as Ben had mentioned, kind of has their own abbreviation or name of the product. But generally, what we're talking about in the repurposing of either new or existing coverage and not fully underwritten, that particular term is known as synthetic reinsurance. Just traditional reinsurance is having a client fully underwritten, going out to the reinsurance marketplace to large reinsurance carriers like Munich, Optimum, Gen Re. These are the very same reinsurance carriers that work with traditional carriers as well in the retail space, like a Prudential or Pacific Life. We actually share some of those same reinsurance carriers here in the PPLI world. So at IPL, if you were to come with a brand new client, we have 6 reinsurance relationships and a total of about 140 million of capacity, and that's known as traditional reinsurance. Where the term synthetic comes into place is we are using a different carrier on the retail side, like a Prudential or Pacific Life or Penn Mutual, and that's synthetic reinsurance, where it's being utilized in the same way, just different death benefit capacity. Where the term PMC comes into place is that is the name of IPL's specific product, or our synthetic product stands for private mortality coverage. Somebody on the marketing side thought that sounded a little better than synthetic reinsurance. I think we could, thank some of the synthetic mortgage. It's kind of an interesting term that sometimes we don't like to have synonymous with one another. So that's the difference between the two.
So it's either existing policy, which is kind of the low-hanging fruit here,
Yep.
already issued coverage, but in some cases it may be a new traditional policy, just depending upon underwriting challenges or capacity constraints that's being used to as the essentially the reinsurance or the insurance component of this type of structure. And
Exactly
then,
correct.
and
Yep.
then the assets that are being managed, I can either choose already pre-baked, as you put it, Ben, insurance dedicated funds or IDFs, or I potentially have a manager that's already approved as a separate account manager uh, on a platform. It might be Crescent. It could be a number of any of the RIAs around the country. Or in some cases, we can help get them approved on the platform so they can manage the money for the client. A lot of times, clients don't want to switch money managers when they're looking at these types of structures. So is that an accurate statement, Ben?
Yeah, and I think a lot of times money managers don't want clients to switch either. So we're
Yeah.
we're happy to help. If you're not approved as a separate account manager on any platform, we're happy to help you get that done. We don't actually do that, but we have relationships that can help you get that in most cases. But yeah, from an IDF to SMA, again, those are the two big ways in which we manage, not we, but the industry manages money inside of PPLI. And again, there's real acceleration in both markets.
Yep. And I think the value add for the wealth manager as well in a lot of these scenarios is they're now managing an asset that's growing tax free, right? So obviously, not only is it bringing some tax advantages, but from a value prop on the wealth manager side, it's usually a very easy conversation as well. Not only more efficient for the client, but more efficient from their management side as well.
That's right. So we've already touched on this, but we'll hit it one more time, and then we'll kind of wrap up the before and after before we take a deep dive into the 3 different carriers and some of the differences between the 3. But again, in our example, the death benefit always is that $30 million host policy or existing policy plus any growth on that 14 million. The owner can choose to reduce that $30 million death benefit or any of your specific situations on the call. If you said, hey, I've got 30 million, I don't think we actually need it. We only need 15 or 20 or whatever it is. Again, that just reduces the ongoing cost, right? If I buy less death benefit, the ongoing cost of insurance will go down. And this is also where we will use term insurance for what it's worth. Again, people are like, wait, how does term insurance work with these types of structures? It's where we know we want to get more premium in early years, and we know the term is going to expire and go away. Actually, is a very efficient use of that term policy to create more capacity for the underlying PPLI policy. And then, as Anthony mentioned and unpacked a little bit as well, the future premiums from the existing policy are paid from the new contract. So that creates some additional leverage, right, by paying that $206,000 premium with pre-tax dollars. Now, again, not every structure works this way, but every structure can work this way if you want it to. So let's take a step back and review what, from our case example, what we had. So the status quo was we had an existing trust with a $30 million policy that insured 2 lives with an annual cost of $206,000 a year, and they had taxable investments of $14 million. We've now moved them into the existing trust owning a $30 million PPLI policy. It still insures the same 2 lives, the same annual cost, only now we've got a $14 million PPLI account that's growing tax deferred inside that policy. And you can see from the chart below the difference, again, year by year over 1, 15, and 30 years, the improvement to the trust assets and what G1 passes on to G2 or G3 just by this one little switch. And this is why we think this is significantly low-hanging fruit. Again, for all the advisors on the call who have clients with existing insurance, maybe not every one of these is this dramatic, right? I mean, not everybody has a $30 million policy. Not all policies are going to grow, or the underlying assets are going to grow at 8%. And maybe the tax drag isn't high. It doesn't matter. It's very difficult. And I would argue it's impossible to beat the cost structure of this, right? When you account for just the ongoing mortality and expense costs. Anything else, Anthony?
No, that's great. Yeah, usually each and every one of these kind of transactions that we've gone through, usually when someone sees it like this kind of side by side, it's usually a pretty clear indication and picture of exactly what we're trying to accomplish. So it's great.
And how many of these have you done at IPL, Anthony?
Yeah, it's a good question. So if I take a look at the entire block, I think there's close to 500 to 600 underlying policies, right, that are in force, that are being utilized in this synthetic structure. I would say taking a look at our business, year over year, it accounts for about 15 to 20% of new PPLI business. So it's not, I would say, a large purpose, right? Or excuse me, not a large percentage, but I would say they're very significant, right? If we take a look at the premium size, it's about 40 to 50% of new premium in our PPLI universe, because these are sizable transactions, right? These are larger life insurance policies that a client has already put in force, and they're very impactful. So in any one year, we're adding on anywhere from 20 to 30 new structures in this PMC world.
Yeah. I know the other carriers have, I think, similar numbers. I don't have them offhand, but I know the other carriers in the space have done a lot of this as well.
Yep.
All right. So I'm actually going to let you take most of this, Anthony, because the competing, your product better than I do, and the competing products as well. But let's just kind of roll through. There's a couple slides here, and for our esteemed guests and friends on the call, we're nearing the end here. I know this is a lot. We're trying to keep things high level, but also give you guys enough granular detail. We actually feel equipped to call us and say, "Hey, I got a guy." But let's talk about the 3 different programs, how they vary, and we've got a couple of breakdowns here. But let's roll with it.
Yeah, absolutely. I know we've touched on it a little bit, but I think the main crux of it is in kind of the administration of the ongoing policies going forward. That's probably what splits the 3 of these apart slightly. In our IPL, or known as our private mortality coverage, there is one extra step of creating a Delaware LLC that is then acquired by IPL for the segregated account of that newly issued PPLI policy. So there's the one extra step that occurs there. What I would say is ongoing. There's the administration is taken on by investors preferred of paying that ongoing premium. And some of these structures, we've been talking about a structure that has one retail policy. Last year, we utilized a structure that has 23 underlying retail policies in one PPLI contract, mainly because we were stacking retention to get to the total amount of death benefit that's necessary. So I don't want to undersell that administration. It could be fairly significant. Now, from a value proposition standpoint, there is no increase in fee that we charge on a mortality expense or administration side. So still keeping with very cost-efficient structure of maintaining that PMC structure and taking on that ongoing administration. Now, what I will say from a plus side of our two competitors, being nice to everybody, Excellus and Crowns, Excellus starting with their Catalyst program, or the name of their synthetic program, is a little bit easier on the front end in that it just takes a irrevocable beneficiary designation, right? So an assignment of the death benefit. So that allows them to be a little quicker on the front end of getting something that's up and in force. And it also allows them to take some different structures like an in-force PPLI contract that we would not be able to do. So that would be an opportunity that maybe would work in that scenario. What would potentially work in that side as well is taking on some policies that have some different structures, like maybe a premium finance structure or something along those lines that we would not be able to administer. There potentially have the ability of doing so. Now, with that said, I would still say one of the biggest things and probably most important of any carrier that you're looking for is we want to make sure that that policy is very healthy, right? We have seen it. Some insurance folks have come and brought us a policy that doesn't look good, and they think if we combine it with PPLI, now all of a sudden it makes both good. Well, unfortunately, that doesn't work, right? We need to make sure that there's something that's very, very good and going forward. And then on Crown side, Crown obtains ownership very similar in the way, but they require 10% of new death benefit that does require some form of underwriting. Now, potentially some form of simplified underwriting, but there is kind of an issue with more of the insurability issues that both Excellus and here at IPL do not have. So that's kind of the main crux of the differences between all three. And what I should say,
Anthony,
quite honestly, go ahead, Ben.
go ahead. I've got another thought for you. We go ahead and finish your thought.
Yeah, funny enough, a gentleman who used to work at Excellus and we used to do a lot of these joint presentations at a lot of these industry events. And quite honestly, anybody that's in the business would say, nope, that's an Excellus case, or nope, that's an IPL case. So there is a pretty clear delineation between these programs of what's going to work best. And we all realize that. I think every single carrier realizes, what case is going to be better for them. So we're very open and honest about that.
Hey, so going back to the unhealthy versus healthy policy, and I'm gonna flip back here to this slide of just the side by side. Is you said somebody brings you a policy that's kind of unhealthy or whatever. Has anyone ever made the argument that, hey, by saving all this tax, we can now redeploy that capital to prop up the underlying unhealthy policy that the client would like to maintain, but they can't for cash flow reasons or whatever? I mean, has that ever been done in the projects you guys have taken on?
It has, yeah. We've seen kind of a rescue, if you will, on some transactions. We've seen some, premium finance transactions that had, lofty aspirations, at one point, and potentially they weren't working out as they were originally illustrated. Now, to your original point that you brought up, maybe even see a reduction in death benefit, right? Maybe it was a $50 million contract, but it's only running out to clients age 60. So maybe a reduction in that death benefit to $20 or $30 million and kind of an ongoing payment moving forward from the PPLI structure is going to run out. So we work very closely with our insurance partners and the broker in the space to say, let's take a look at in-force illustrations. And it goes to our PMC team to see, is this policy running out to maturity? Not at 12%, right? But it's something like 6 or 7% hypothetical, something that's very attainable to make sure that that policy is going to remain healthy. Because that's kind of the issue for all of these structures. If we have an underlying policy that fails, the whole kind of structure.
Yeah, right. Ryan.
Yeah. What is a question from the audience? What's the minimum premium and or length of premium payment period that's typical for these types of policies or structures? We're showing this $14.1 million premium, but what's kind of on the bottom end of what is realistic or acceptable to do where the cost and complexity is not overwhelming in comparison to the savings?
Yeah. So our minimum premium or minimum stated premium is $2 million. And that could be, $1 million a year for 2 years, 500,000 a year for 4 years. That's the minimum premium. Now, I'd be lying if I said kind of going through this entire process, and, Ben might have an opinion on this as well, but we usually see, at least $5 million plus of premium where it's going to be very impactful to the client's overall plan. Now, the nice part about that $5 million and up is kind of that magic number as well to potentially create a separately managed account that we're seeing a lot of this industry move to. So if I were to put a kind of a good benchmark, that's usually where I would see a lot of these conversations should at least start.
Yeah, I would agree. I mean, I think you could do something as low as 2 million. But I think one of the things we've discovered is the asset management component of a $2 million policy just becomes difficult, right? I mean, there's just constraints around that may not be worth the squeeze, so to speak. But I would say, and again, from a minimum premium number of years, you can do it all in 1 year. You can spread it out over 4, 5, 6 years if you wanted to. A lot of the times when we're doing this, though, we're typically going to get in pretty quick. So it's typically a 1 to 4 year payment cycle to get the money in and get it invested. Last thing I'll mention, just some of the 3 different programs, just to kind of wrap that up, is Excellus will issue policies from 0 to 85, Crown 18 to 84, and then IPL's 18 and up. So really wide swath of availability. And maybe touch for a second, Anthony, on why 85? Why do you guys stop at 85?
Yeah, so Excellus stops at 85.
Sorry.
Yeah.
You don't.
Yeah, so the reason why
my bad. Why would Excellus stop at 85?
Yeah, it goes back to the retained risk, right?
Yeah.
So the nice part about retaining a small amount of risk is, let's say, for example, they have a 90-year-old, right, that comes and they assign the death benefit. They're issuing $125,000 of risk, and that client could potentially die tomorrow, right?
Yeah.
Or have a low life expectancy. Because our retained risk is so very small, we can go ahead and take a client that's in their 80s or, even potentially early 90s. Because we're not taking a large amount of retained risk. And Crown is very similar, right? Where they're asking for new underwriting for
risk,
10% of the death benefit. So that gives us a little bit more flexibility in our overall structure. And, even have a case that I know at the last conference we talked about where a client was in their late 80s. And, even if there's life expectancy of 5 years plus, there's going to be a tax hedge that still makes sense to do it.
For sure. All right, we got one more summary page, and then we'll get a polling question, and then we'll open up for some more Q&A. So, as we like to say, repurposed or synthetic PPLI is the ultimate have your cake and eat it too strategy. We can use any policy type. I'm gonna keep hitting you guys with this, but any policy type, no underwriting, no loss of death benefit, no change to estate planning. We can deposit those new premiums into a custodial account of the client's choosing, or the advisor's choosing, a Schwab, Fidelity, etc. Invest as you have previously, and then you get the same asset class exposure minus the income and capital gains tax, and no K1 reported. So it is absolutely it's as good as we are telling you it is. There's no hidden boogeyman out there, right? There's nothing. There's no monsters in the closet, so to speak. It's really an amazing strategy for the right folks. We've achieved all of our learning objectives, so you guys get all your CE. Want to stop real quick and mention the resources we've created around PPLI for all of you on this call. So if you hit the QR code, that'll take you to the handbook, the ebook that we wrote. Also, on that same page, you're going to see a bunch of resources, videos, case studies, white papers, deep dives. We also have an executive summary of this concept that we will email out to everybody here on this call today. It's a one-pager. technically two because the disclosures are on the back half of the page, but it's a one pager on how to explain it simply and easily and not get bogged down in the details. And we'll get that to you guys when we're done here. We'll also email a copy of this presentation to everybody as well, and it will be posted on the website as well. And then lastly, we have some more great content coming your way the rest of this year. You can see here on your screen, we have the WP90X, which is what this is. So 90 minutes, you get an hour of CE. We've got a great one coming up in June on life settlements and other underutilized exit strategies. We've then got one in September around compensation clarity and post-issue service. And then in November, the art and science of the $100 million life insurance case. So some great stuff on more traditional types of life insurance. Again, not all PPLI focused. The PPLI deep dives, we'll be running those the rest of the year. You see that as well. Some really cool. These are basically topics that keep coming up over and over. How to access your money, why people don't put more money into these policies. We're gonna do a 60-minute deep dive on that. The Roth conversion strategy is a really cool strategy, as well as debunking the top 5 myths of PPLI. So if you want to sign up for any of those, hit our website down there at the bottom, wealthpoint.net/events. And Ryan, any further questions?
Yeah, Anthony, you had described potentially sharing a white paper. Would you be willing to share that with us so we can send that out with the materials?
Absolutely.
And then last question, I know the guarantee in terms of the guaranteed coverage is going to be based on the underlying product that's being assigned, but the 10,000, whatever the retained risk is that you guys have, is that I know it's a guaranteed issue contract, but it is also a guaranteed contract as well?
As long as the underlying PPLI policy remains in force, it is. Yep.
Okay.
It is. Correct.
All right.
Yep.
Thank you.
Absolutely.
Well, thank you everybody for joining us. We hope you enjoyed this quarter's edition of WP90X. A big thank you to Anthony Stanek for taking the time to educate our folks. And again, reminder, if you're going to get the survey, please make sure that you complete the survey so we can accommodate you with your CE accordingly. So without further ado, we'll let you on to the rest of your day. And thank you very much to our speakers.
Appreciate it. Thank you.
Thank you.